I'm Ian Welsh from Innovation Forum, and this is our carbon debate. We're looking at the reforms necessary for voluntary carbon markets. But as I say, we'll start just in a sec when I think that we've got everyone that wants to join is more or less joined. As I say, there's always a little bit of a delay as people join Zoom. Okay, well, look, let's get cracking in the interest of time. I'm sure more people will join us in the next few minutes, but we'll get cracking. Welcome, I'm Ian Welsh from Innovation Forum, and this is our new series of debates. And today we're going to be looking at carbon, and in particular, the reforms that are necessary for the voluntary carbon markets. What we're going to be doing is taking contentious issues and trying to get to the bottom of any misinformation, debunking what has to be debunked, and we'll aim to find out what reforms are necessary. So we're going to talk about voluntary carbon markets and carbon projects today, and think about what companies need to know to have confidence in the sector and the role that the carbon markets can play as the world economy decarbonizes over the coming decades. Recently, corporate use of the voluntary carbon markets and verified emissions credits has come under intense scrutiny, and comment reporting in The Guardian and elsewhere has claimed that many certified credits do not represent genuine carbon reductions. On the other side, certifying bodies and others supporting the use of the voluntary carbon markets and projects tackling deforestation have stoutly defended verified emissions reduction credits and the science behind the certification. Certainly, the voluntary carbon markets are imperfect. Challenges include establishing baselines and accounting methodologies. Nevertheless, carbon projects, including REDD+ projects, are perhaps the best method we currently have of getting finance to indigenous communities so that they can value their forests with the trees standing. I'm delighted that joining our webinar panel today, we have David Antonioli, who's the CEO of Verra. We have Bea Natzler, Team Leader, People and Business at the UK's Climate Change Committee, and Sam Gill, Co-founder and President with Silvera. And my thanks also to Innovation Forum's Bea Stevenson and Diana Kim, our webinar tech hosts, for all their work in the run-up today. We are recording the session, and we'll share the link with you all after the webinar, so you can listen again and share with your colleagues. I'll turn to our panel very shortly, but just wanted to point out that we do want to hear from our audience. So please do use the Q&A function for all your points, comments, and questions, and I will bring them into the conversation. You can, of course, rank the points and questions for others, and the more popular a point is, the more likely I will bring it into the debate. And please, if you can, include your name and organisation when posing a question. Now, while it might be tricky with the number of people we have on the call, we'd also like to try and offer you the chance to make your comments or pose a question live in person. So if you'd like to do this, please use the raise arm function, and we will enable your audio and bring you in at an appropriate point. Please keep any intervention short and to the point, and I reserve the right to enforce this. And of course, the usual Innovation Forum rules of courtesy at all times will apply. Great. Let me turn to the panel first then. David, welcome. Verra has developed climate action standards, including certifying carbon credits, and you are in the firing line, it's true to say, from The Guardian's articles and have publicly and robustly responded. So let's start by picking up the main allegations from The Guardian. Seemed to me they really fell into three buckets. Firstly, that few projects have demonstrated reduced deforestation. Secondly, that threats to forests and projects have been overstated. And thirdly, that there are some serious human rights concerns at projects. So David, taking those in turn, how do you counter those?
Well, first of all, thank you, Ian, for the invitation to speak here. It's a pleasure, and I look forward to the conversation. So, I mean, just to begin with, Verra is absolutely committed to developing and enforcing the highest standards for many different types of environmental projects, including REDD. And we take these allegations very seriously, but it's really important to note that these are sensationalist headlines. What The Guardian published came from basically the core of these allegations came from one academic who relies on a desk-based top-down model to assess something that requires a bottom-up analysis. And he's essentially comparing apples and oranges. By this, I mean that the approach taken to assess these projects looks at, sites that are selected by the study that in many cases do not reflect the same forest type, do not reflect the same kind of socioeconomic drivers that are affecting the project, and in many cases are located far, far away from where the project site is. So we're essentially comparing apples and oranges. And then The Guardian takes that analysis and, extrapolates it and then uses that to make these outlandish claims based on their own analysis on the initial analysis. And let me just be very clear, the second study in this reference in the Guardian article, doesn't throw REDD under the bus. In fact, that study recognizes that the projects are actually protecting forests and conserving forests. So I think that the problem here is that they've taken a very small, one study, blown it up, and used it to make these outlandish claims that lead to sensationalist headlines. And I think that's very unfortunate, to be perfectly frank. And we've set it out. I can put our technical response in the chat for people to review, but I think it's very important for people to understand that that's what's going on. And we've refuted these pretty robustly, in webinars like this and in other places. I think what's really important as we take a macro view of this is that, all sectors are subject to evolution, and REDD and the carbon market is going through an evolution. And years ago, we started a process where we wanted to revise the way baselines are created. You mentioned baselines in your initial comment. The reality with REDD is that you have to have a counterfactual to make it work, and that's something that's just a fact of reality. And you have to have the best ways of identifying that. When we first started this journey 10 or 12 years ago, we developed a set of rules and procedures that were based on the best and the latest scientific best practices, the best understanding of how you did this. And the conclusion was you have to identify a reference area to basically compare your project site against. And that was understood to be the best way. That's what we did. And we actually on purpose created or allowed the creation of a number of different methodologies, because nobody had put pen to paper and understood how you actually use carbon finance to protect forests. So we thought it was a worthwhile exercise to move into this and figure out how we could do that. And so, over the years, we've learned, we've pioneered a lot, and certainly we've done some, but a lot of the people on the ground have put, a lot of effort and a lot of investment and a lot of work into making these projects work. And you can go to any one of them and see the impacts of them. And we now have a robust set of projects that are protecting forests, helping communities, conserving biodiversity. And that I think ultimately is the key thing here. These projects are having an impact. And now, if you roll the videotape forward to kind of where we are today, we now decided, okay, we've now had that moment where we've been able to allow a number of different approaches, and we need to bring them together. So going forward, we're going to consolidate the methodologies, and there will be a single methodology that people will have to use. All existing projects will have to use that going forward. The methodology will be based on a jurisdictional baseline. Again, people have been talking about jurisdictional baselines for years. In fact, when we first started this journey 12 years ago, we thought that was the bee's knees. We thought that's where we wanted to go, but there were no working models. There was a lot of methodological gaps on how you actually did that in a robust way. Today, and now we have that data that we can create robust jurisdictional baselines, and that's what we're going to do. We're going to use a robust jurisdictional baseline, and then we're going to allocate down to individual projects based on the risk profile of the project area that's being conserved. And so that's just a great example of how we're moving forward. We've also had a few other improvements that we're doing to the work. So we now require baselines to be reassessed every 6 years. And of course, now we have a lot of digital and satellite imagery that we're working to figure out how we actually embrace it and use it to robustly and transparently, verify the reductions that are being achieved. So to come back to the overall message, I think there's a real positive look for REDD going forward in carbon in general. But even if you take a step back and we look at the forest and the trees, let's not forget that today, the debates happening, at least certainly a few miles away from here, where I live in Washington, D.C., in Congress, are about prohibiting companies from considering ESG in their investments. So we need to be really mindful that where we have gotten to in the voluntary carbon market, in many ways has helped drive this consciousness about the importance of climate and the need for companies to do something about it. But now it's coming back around, and a lot of people saying, oh, no, you shouldn't be doing that. And they're actually thinking about implementing laws that prohibit companies from considering climate in climate and other social and governance issues into their considerations. And I think that as a macro view should really galvanize all of us in the sector to make sure that we keep a focus on making sure that corporates, understand and value the importance of taking action, because otherwise they're just going to sit on the sidelines. So I'll stop there. Thank you very much again, and I'll look forward to the conversation.
That's fine. I'm conscious that the specific questions I put around projects not demonstrating reduced deforestation, threats to forests projects have been overstated, and the human rights concerns. We didn't get to those. Could you just very quickly run through each of those? So how do you counter the point around projects have been demonstrating or not demonstrating reduced deforestation?
Well, I think, you have to look, let's look at so I think it's wrong. I mean, if you look at the evidence, projects are advancing against their baselines. And the important thing to note is that for red and all carbon credits that kind of have, with their salt, you only get the credit when you've demonstrated you've conserved. So if there is deforestation on a plot of land that you're trying to conserve, you're not going to get the credit. And so that's really important. So the credits that are in the market represent real emission reductions that have been achieved. The baselines, I did mention that, the baselines are developed through a process where you identify a reference area. And that's where, that's the process I described before. And the baselines are, we believe, robust, and they followed a process. I think that's really important. It's easy for someone to say, oh, I've got a different baseline based on a different assessment I've made. Well, the importance is that as a standard setting body, we have a set of procedures that projects have to follow in order to create their baselines. And that's not an opinion, that's a process. And I think that counts for a lot. And I think that's really important to note. So we stand behind all the credits that have been issued, but we are moving towards this new method of assessing the baseline and setting the baselines that is based on a jurisdictional baseline being allocated down to individual projects. And on the human rights allegations, those there's a process for following that up. I understand that there was some allegations in the Alto Maya project. I know CI is investigating those. Whenever we receive a formal complaint, we'll investigate it. But that's being investigated, through the CI process, and I believe that we'll take action if it needs to happen. But we need to wait for that process to play through.
Sure, thanks, David. And I guess your more detailed response to the allegations are all on your website, so anyone on the call can go to there and see the more detailed rebuttal of the points raised by the Guardian story. We've put the link to the Guardian content is on the Q&A if anyone wants to have a look at it while we're going. So, David, thank you very much indeed. Lots to come back on there as we go. And thank you also, everyone. Great that we're seeing so many questions already. As I said at the top of the hour, use the Q&A function, please, to put your questions and points, and do use the, you can rate the question. So if you like the question there that you see, then do rate it, and it'll come to the top of the list, and it's more likely that we will use those. So thanks so much indeed. Now, B, let me turn to you. The Climate Change Committee, it's the statutory provider of advice to the UK government and the devolved administrations in Scotland, Wales, and Northern Ireland. So from that perspective, then, what for you is the role of the voluntary carbon markets?
Thanks, Ian. Yeah, it's a really good question. So last year, myself and my team recognised that the voluntary carbon market was a space where there were a lot of quite strongly held opinions on different sides, and saw quite a lot of value in ourselves as an independent advisor assessing the evidence against those risks and opportunities that people point to. The main opportunities being channeling funds towards nature-based solutions, or even more long-lived permanent removals, and the kind of main risks being slowing corporate action and the possible low quality of carbon credits. So maybe I'll just briefly talk through, first of all, what we found when we reviewed the evidence in terms of the concerns, and then the opportunities. So in terms of the concerns, the key thing that came out from our evidence review was a real risk that the voluntary carbon market would be slowing corporate action, indirectly reducing emissions. And I should preface this was done with a UK lens, but I think it's probably hopefully applicable in a broad sense globally, though I wouldn't want to say that the evidence we looked at was global in this regard. So firstly, we reviewed the price of carbon credits, which is, as other panelists I'm sure are aware, incredibly low. So the global average is around $3 per tonne. And when you compare that against recommendations from various bodies for what an appropriate carbon price is, or EU ETS permits, which range from $50 to $100 per tonne, you can see that there's a clear incentive there for businesses if they're considering a credit as an alternative to actually decarbonising, to go for the sort of more affordable, cheaper option. This is a real concern because to reach net zero in the UK and globally, we need real concerted UK business action now to reduce their own emissions. So, for example, in the UK, we estimate that around 2/3 of UK emissions are business scope 1 emissions. So, and we need to see those rapidly reducing in the next few years. So, as a priority, we really need to see businesses investing in their own supply chains, their own operations to reduce those emissions before they look to carbon credits or offsets. And just a sort of a final piece of evidence perhaps to note there is we did a review, or we commissioned a review of the published FTSE 100 emissions reduction plans, and found that out of the third of them that outline plans for using carbon credits for offsetting, on average, they covered around 80% of their emissions under a certain methodology, another up to a third, either way of which is sort of much higher than it should be if offsets are being used as a last resort. So yeah, that's like kind of a primary risk, I guess, that we focused on. And I guess it's worth noting here that if carbon credits are being purchased by businesses and that's not disincentivizing them from directly reducing their own emissions, it actually becomes a lot less pertinent, the exact measurement of carbon credits and if it's exactly right, given the challenges with baselining and the like that David mentioned. So if we're really confident that businesses are sort of purchasing credits purely as an add-on and are directly reducing their emissions, it would be great if they were really accurate, and we would like that, but it's less of a sort of big risk to net zero. But then to come to that other side, we also did a review of the risk that carbon credits are overstated or providing inaccurate claims for carbon reduction, avoidance or removal. And our evidence review did find significant concerns that in general, internationally, over, I guess, around a sort of 10-year period, there was strong evidence that there have been credits that overstate the impacts, misjudge the baselines. And often this is linked to the challenge of additionality, which, as David has mentioned, it's not for lack of trying, it's a really challenging area to get right. And it's sort of, to put out a baseline, particularly when it's around avoided emissions, it's really hard to know exactly what that would be and to get it right. But yeah, we did recognise that there's a real concern there. And I think, yeah, perhaps moving slightly into the opportunities then, this points to where I see a kind of there's a few key opportunities. So the first that I would point to is the value of channeling companies' goodwill and desire to sort of contribute to the wider global efforts on preserving nature without distracting from corporate emissions reduction themselves, through things like a kind of carbon price or committing to a set dollar per tonne to contribute to emission projects without using that to claim that it's fully offsetting business emissions. Perhaps two other things on opportunities as well. So we looked at the opportunity that people often point to for carbon credits to support nature-based solutions, improve biodiversity, etc. And we found there was some degree of evidence that they can support that. Although I would caveat it that for them to make a sort of large dent on global financing gaps for nature-based solutions, we will need to see a really large increase in demand for carbon credits and a really large increase in price, both of which could be possible with the right controls in place. But as it currently stands, it's quite a small fraction. So not to undermine it, but I guess to make sure that voluntary carbon markets aren't seen as a get-out clause for governments themselves to support international climate priorities or other mechanisms needed to support nature-based solutions as well. And then the final thing I'd say is around like engineered removals. So in the UK, we need to see some significant financing going towards this, because while most emissions we hope will be directly reduced, some may remain and will need to be offset with engineered removals and land-based approaches. And there's a potential for voluntary carbon markets from a UK perspective to provide a bit of a stepping stone towards compliance markets, where businesses are then actually required to purchase permits or the like that contribute towards removals. So yeah, that's a bit of a whistle-stop tour of our report. I can definitely post the link in the chat, and yeah, happy to answer any questions.
Thanks, Bea. I think it's really important, the point you alluded to is the having the right mitigation hierarchy. You can only really be thinking about going to carbon markets once you've decarbonised your own operations as far as you possibly can. Carbon markets are not there to decarbonise your operations. You need to do that yourself, and that's a really important point. David, I wonder if you want to come back on any of the issues that that Bea raised there.
No, I mean, I think that, I think I think that there's this fear that voluntary markets are going to distract us from climate action. And I'm not sure I agree with that. I think that if you look at many of the corporates that have actually bought carbon credits, they actually have a responsible approach, and they're doing internal reductions and they're offsetting. I think the holy grail of climate action from a voluntary carbon perspective, but from a climate action perspective, relying on the voluntary carbon market, essentially requires companies to take on net zero targets, perform against them, and offset their residual emissions. That's kind of the perfect thing. And a lot of companies are doing that, not many, but that's where we need to be going. And that will actually get us to that state where we actually can do net zero. But let's remember that carbon credits today allow us from making the problem in 2050 a lot worse. So let's assume that all companies take on net zero targets. Great. But by the time we get to 2050, we will have emitted a lot more carbon than we need to if we don't offset it now. And we will lose a lot of forest, we'll lose a lot of biodiversity. And importantly, to talk about the removals that Bea mentioned, the carbon markets can actually help drive finance to these removal technologies. That's a really key thing that carbon markets can do. And we can start to drive finance to those new technologies, those new approaches. Removals are really critical, but they're either expensive or they take a long time to deliver. If you look at a reforestation project, you're not going to get carbon for 5 to 10 years or more. So we need to start making those investments. That's why I think the voluntary market can be really critical, but it does need to work in conjunction and complement internal reductions. I fully agree, but I don't think it's as easy as to say, oh, just because people are investing in carbon markets that we're distracting from real climate action. I think the key is to really drive both.
Thanks. Thank you, David. Again, loads we can come back on as we go. Sam, thanks very much. Welcome. Thank you for your patience. So Solvera, amongst other things, Solvera ranks carbon credits. Given the complexities involved, and as we've heard, how do you advise your customers to find the best projects and work out what is right for their circumstances? Sam.
Amazing. So thanks so much for having me on. Just introduce Solvera to anyone who's not aware of it. As you say, Solvera is a company that rates the quality of carbon offsets. So we use very in-depth ratings frameworks for each project type and assess in a huge amount of depth and accuracy exactly what each credit is doing. So for example, if we were looking at a REDD+ credit, we look at 3 key pillars. We'll look at the carbon score of the project or the performance of the project. So we'll look at, has the project done what it said it would? So if the project's reported that it's stopped deforestation completely, we'll assess and check whether that's actually happened using our own technology. We'll assess the additionality of the project, including the baseline, which, as David mentioned, is the piece of the puzzle that the Guardian article was particularly focused on. And we'll use some of the techniques actually that were included in the Guardian article to actually assess these projects. But I think, as David mentions, it's a bit of a simplistic assessment that's been used by the Guardian in this case. And so actually the figure that they've used for the headline in that article is probably quite misleading. And then the third thing we do is we look at the permanence of the project. So we look at, are these projects storing carbon for an indefinite period of time, or is there a kind of significant risk that the carbon might end up in the atmosphere again? And I think it's just helpful to note we collate all that data, and then we produce a top level rating that runs from AAA down to D. And if we look at the distribution of quality in the market at the moment, there is a significant distribution of quality. So we do see a number of credits that, according to our frameworks and our assessments, and we're putting hundreds of hours of time into each single rating and thousands of hours into each of the frameworks, we're seeing that there are a significant number of credits that are not delivering on the claims that they're making. But we're also seeing a significant number of credits that actually are providing a huge amount of value and are definitely having impact. Now, I think the point that both Bea and David have made, I think, is that, look, especially when it comes to nature-based credits, especially when you're looking at a counterfactual, it is very hard to say with complete confidence that the number that any project comes to is completely accurate and completely correct. And also, when you take into account the changes in the biosphere that are happening because of the accelerated pace of climate change that we're already observing, increasingly, we don't know in 50 or 100 years' time how these ecosystems are going to behave and whether they're going to be viable in the long term. So there is uncertainty around these credits. Even the best credits, we see uncertainty. So if you know, your question around how we advise our clients, what we're able to do is point them to the best credits, the credits that are having the most impact. But I think the other piece of the puzzle is what sort of claims the corporates or the companies are making when they buy these credits. And I think it's probably helpful to question whether a carbon neutrality claim or a net zero claim at this point of in the decarbonisation journey is really very helpful, especially when we take into account the uncertainty. And as David says, it's really important that we protect these ecosystems. And in many cases, a lot of companies are actually restricted in their ability to completely decarbonize in the short term. They couldn't do it if they wanted to, even if they had infinite cash. And so I think it's really, really important that we find maybe a third way in which we can encourage and incentivize corporate climate action. And the voluntary carbon markets can be a very, very powerful tool in doing that. But perhaps we're a bit more honest about the uncertainty that sits around the crediting mechanisms and the quantification of the impacts of these projects, because you know, at this stage, it almost feels like the carbon neutrality claim is becoming a distraction. It's actually fueling a perhaps unhelpful debate around the quantification of the impact of these credits, when actually, if we're honest, the quantification of corporate emissions and even national emissions is very, very problematically wrong as well. So there's an equivalent accuracy issue on the corporate accounting and national accounting side too. So focusing this of unhelpful level of sort of scrutiny and demand on the voluntary carbon markets because of the carbon neutrality debate is almost, I think, distracting from the bigger picture here, which is about contributing to the global push to net zero whilst you're on your own net zero journey. So that would be basically how we speak to our clients and we support that. Yeah.
You said, interestingly, you said that sometimes net zero claims are unhelpful because of the uncertainty. So if we're not going to be looking at net zero, what do we look for then?
It's a really good question. I think that's a debate that we're seeing growing at the moment. So if we move away from a carbon neutrality claim, what are the alternatives? I think there are a number of alternative claims that are kind of popping up. Some people are preferring a mitigation contribution style claim or a contribution claim. You can talk about contributing to the global net zero journey or contributing to mitigating your immediate impact whilst you're on a net zero journey. So there are lots of different terms that are sort of starting to pop up, but I think the theme we're seeing among some of our clients is a shift away from this offsetting or net zero carbon neutral claim towards this sort of contribution claim. But I'd be interested to hear if maybe you've thought much about this.
Thanks. Let me just go into a point that's been raised by our audience around speed of talking. The questioner points out that we are talking as we are all native English speakers, and we are talking perhaps too quickly for some of our audience. So perhaps all of us, and I'm as guilty as anybody, we will try to speak more slowly. We are having, as I said, we are recording the webinar. I will ensure that when it is edited, that the audio editor is conscious of trying to slow things down when necessary so that it is more easily understood by non-native speakers. So thank you for the point. It's a very good one, and one that we will address when we redo the editing of the webinar recording, so that it will be slowed down so that it is easier to understand for non-English speakers. But very good point. Sorry, B, back to you.
Thanks. Yeah, I really agree with what you said there, Sam. I think this is something we thought quite a lot about in the development of our report. And there was a concern that claims and the sort of focus on net zero from companies can, as you've alluded to, sort of be seen as sort of disingenuous, particularly because they often don't stack up with the level of robustness of, say, national net zero targets. And that can undermine the kind of reputation of all net zero targets and throw anything linked to that, including voluntary carbon markets, into disrepute. I think contribution credits and contribution claims This is something we recommended the government look into how they can encourage. I think the challenge is, and you will probably know this better than me, Sam, how to make sure that it's got enough reputational gain for a company for them to have enough incentives to want to pursue that. We also considered thinking about a label of sort of like on track to net zero, or even offset zero, though I think that has too many negative connotations, that would capture that a company's sort of in line with, say, like an SBT's aligned emissions reduction and is choosing to contribute to credits that help, that sort of match its residual emissions without suggesting that it balances out or kind of counts as being zero. I think there's different ways to do it, aren't there? Yeah, the other one that I think I mentioned earlier that I think is interesting is when companies commit to spending a certain amount of money per ton of emissions that remain, because that both creates that internal incentive to actually reduce their own internal emissions and ensures that a sort of a decent price is being spent on the project, so that hopefully they're relatively high quality. Definitely don't have all the answers though. We're not experts on business, but those are some of the options that that we considered.
David, you don't come in on the net zero terminology, and if not net zero, are there other ways we can look at achieving ultimately what it is we want to achieve?
Yeah, I mean, I'm looking at the title of the webinar, right? What reforms are necessary for the voluntary carbon markets? I think there's been no agreement whatsoever on what companies can claim. I went to the supermarket the other day and saw 2 cartons of milk. One said climate positive, the other one said neutral. And I think I know my stuff here. And I was like, whoa, what am I, and I looked at the back, right? And the one that said climate positive was like, yeah, we're going to do all sorts of great things, but they weren't very clear. And fair enough, it's, for a consumer audience. But my point is that, the term carbon neutrality came into mode years ago, and people have been using it, but nobody's really taken the time to define what that really means. And it has led to the perception that some people are using the carbon markets to greenwash or to just, get out of jail free. And I think that's been problematic. We need to do something about it. But there is an organization doing this. There's the Voluntary Carbon Markets Integrity Initiative that's done a public consultation, and they're trying to define what kinds of claims companies can make when they're buying offsets. And again, I think the top level claim is, like I described before, you have a net zero target, you're on your way, you have evidence that you're performing against it, and you're offsetting the residual emissions. That's the holy grail of carbon markets or climate action, if we really want to look at it that way. And I think, and there's different gradations of how you can go, not get that top star, but you can get something below. But I think that's really important, and think, hopefully in several months, I don't know the timeline of that initiative, but I'm hoping that they'll come out with something that says, okay, guys, here's the rules. Like, if you do this, this is what you can claim. If you do that, this is what you can claim. That's going to be tremendously beneficial for the market. And I think that'll be very helpful as we go forward. And there's another initiative kind of on the supply side as well, which we can talk about as well. But anyway, I did want to mention the BCMI, because I think we do need to have some sort of global or sector agreement on the kinds of claims that companies can make. So otherwise people just say whatever they want and sell you milk that's carbon neutral or climate positive, and nobody really knows what it means.
I agree. And the other thing I'd probably mention is also the Science-Based Targets Initiative is it's just kicked off its working group on beyond value chain mitigation, which is their way of talking about offsetting or carbon credits. And so there'll be some guidance there. And I think one of the perhaps unfortunate interpretations of what I think is a very important message from the SBTI has been their emphasis on reducing your emissions first. I think a lot of people have interpreted that as a call to ignore the carbon markets or not engage in the carbon markets. But I think what the SBTI has tried to make clear is that they actually think it's very important that you engage in, mitigating or engaging in the climate types of activities we're discussing here to deal with your residual emissions and address those. So, there are a number of entities that are working around trying to bring some clarity in this space. But I think what's increasingly becoming clear from our perspective is that it's this neutrality question that is actually causing a lot of the controversy.
Great, thanks very much indeed. Okay, thank you very much for all the questions. We've got a lot of questions to get through. I'll try to get through as many as we can. Question that's top of the list is one I think that probably initially for you, David. Can can you address the issue of the counterfactual baseline and how the conservativeness of that baseline can be assured? And thank you to John Schindler for that question.
Yeah, I've been seeing the question and trying to start typing answers, but there's so many of them that it's going to be really hard. And then I realized I was losing the thread of the conversation. So apologies for not responding to all the questions. But yeah, there's a few ways. I mean, basically, there's requirements in our rules that require conservativeness when you have different emission factors, for example, and that plays out throughout the process. And I think that ultimately, this new approach that we're developing, will provide an overall envelope, if you will, for the total emission reductions that can be achieved at a jurisdictional level, and that gets allocated down, and that should give more confidence to folks that the projects actually have a baseline that reflects kind of the potential at the jurisdictional level. So there's all sorts of controls. I mean, we did want to mention, I saw one question quickly. We put out, and going back to the point about constant improvement, we just put out a consultation for what is likely to be version 5 of the VCS standard, and we encourage anybody to participate in that and give us some thoughts about how we can actually continue to improve the market and our rules and procedures. So we'd certainly appreciate and encourage everybody to look at that. I can drop that into the chat.
Thank you. Yeah, anything that panelists that you want us to share with our audience, we can do so when we send out the link to the webinar afterwards. So another question, the second most popular question, again, thinking about Vera, the question asks why your JNR methodology, and I guess my ignorance, I'm not quite sure what JNR methodology is, still to be taken up by the market, and what has changed that allows Vera to require jurisdictional baselines going forward is the question. Do you want to address that, David?
Can you repeat the question? I didn't see that.
Why has Vera's JNR methodology been slow to be taken up by the market, and what has changed that allows Vera to require jurisdictional baselines going forward?
So why has Vera's JNR methodology been taken up or not been taken up?
Been slow to be taken up by the market.
Well, I mean, I think the main reason is that, we don't have a big buyer behind us. I mean, that's the bottom line. We developed JNR. JNR is our jurisdictional and nested red framework. We developed it about 10 years ago. And it's been out there. It was the first jurisdictional framework out there. But there was nobody kind of standing behind us saying, hey, I'm going to buy all those credits. The World Bank came in and said, hey, I'm going to buy, or we'll buy credits, but then they created their own methodological framework. And so did our trees. So there's, and so when governments are looking at who they're going to, work their credits through, that does kind of inevitably mean that we don't have that much demand for JNR, although there are some jurisdictions that are moving forward with that. And I think it's still early days, but I think ultimately, again, we think JNR is a great methodology. One of the great things about it is that it's the only one of these jurisdictional methodologies or approaches that has rules about how you nest and integrate individual projects. And I think the solution to forest conservation includes both work at the jurisdictional level, where you can actually drive regulations and incentives at a high level, at a macro level, but also the project-based approach, which allows projects to deliver direct benefits to individual communities, which is really critical. And so the second part of the question was what, Ian? Sorry.
Sorry, where are we? Oh, yes. The question was asking what has changed to allow you to use a jurisdictional baseline going forward.
Right. Well, there's now enough evidence that you can develop a robust jurisdictional baseline, and we now have models for how that's done, and we have examples of that being done, and some of the methodological gaps have been filled. There was a question. I'll try to answer the questions if I remember them. There was a question about what does this mean for us working with government? So in some cases, our baselines may actually work, be the exact same as the government, but we do have a set of rules and requirements that we're going to be putting forth for the development of these jurisdictional baselines. And in some cases, it may be different than what the government might approve. Again, there's a lot of different dynamics at play, but we think that there's a body of knowledge, and we'll be putting out as part of the new RED methodology, a call for data, like what we're calling activity data, to be able to inform the development of those jurisdictional baselines. That'll have a set of requirements that we need to put in place to make sure that all the credits that we issue around the world are fungible with each other and have the same set of rules.
Thanks, David. We've got a question here, and I'll put this to B and Sam. And so, insetting, what's the role of insetting? Our questioner just very simply asks, what are your thoughts about insetting? So, B, where does insetting fit into all of this?
Yeah, very supportive of insetting. It feels like it's sort of in the mitigation hierarchy, probably comes before offsetting, right? Like focusing on tidying up your own backyard before looking elsewhere, ideally, although doing both at once is also obviously great. So yeah, it feels, we haven't looked into it in detail, but in our report, we did recommend that that's one of the sort of, it's not quite beyond value chain mitigation steps, one of the key steps businesses should look to prioritize before looking to offset.
Yeah, although from our side, I think I'm a little nervous about insetting as an approach because if you look at a lot of the proposals around how companies are going to use insetting, often it's that they're changing their land management practices. So they may be, for example, like reforesting parts of the land they control, or for example, if it was an agricultural company, they would change their land management techniques to take into account and try to promote the uptake of carbon on their land. We've heard from David how difficult it is to create cast iron and robust methodologies to quantify the impact of land management techniques and the amount of carbon that land stores. And so in the offsetting world, there's a lot of scrutiny around those methodologies, but for a lot of corporates, they're producing very limited data or divergences around how they're actually calculating the impact of their insetting. And so there's a world in which all of the scrutiny around offsetting just forces companies to push that activity into their value chains, call it insetting, and then there's a lot less scrutiny there. So I think it's quite important that the same level of scrutiny is applied to insetting approaches as applied to offsetting, because there's equivalent issues with the monitoring and the verification of the impact of that activity. And I think there's even more danger where a company starts to use land management techniques or nature-based solutions, and they bring them into their value chain. So imagine an energy company buys up a forestry subsidiary, says that's now part of my value chain, and then effectively create offsets in their own sort of corporate structure, and then say, look, I'm not offsetting, I'm insetting, and there's less scrutiny there. So I think the market actually needs to think about the signals it's sending to corporates by encouraging insetting versus offsetting, because at the moment there's a lot less scrutiny there. That would be my thoughts on the subject.
Oh, sorry, Ian, can I just add one more thing?
Sure.
And it's just, we didn't manage to get very robust evidence on this, so this is pretty anecdotal, but we also did hear from stakeholders when we ran a call for evidence concerns around companies in the UK buying up large swathes of land and sometimes disenfranchising local communities, which can also be a risk with offsetting projects. So I guess it underlines your point really, Sam, that whatever approach is needed, we need robust controls and good methodologies.
Yes, my point was going to be, it does come back to the hierarchy we talked about before, in terms of you just have to be decarbonising everything you possibly can do, and you can't just use something else to offset that if you're not decarbonising things that you can decarbonise. Okay, great question, or great point from Daniel Pointner, who makes a point, and I'm interested in hearing what all of our panel think about this. And essentially, are the voluntary carbon markets always going to have or attract sensational headlines? That's just the nature of the beast. Do you agree, David?
Interesting. As long as we have a circular firing squad amongst the environmental movement, yeah, maybe. But I saw another comment there about, like, this is probably the most robust and transparent way of accounting for benefits. It's much more robust and transparent than the way many donor agencies account for the benefits of the projects that they do. All the data is available online on information. And so it is interesting that because we are so transparent, we do put ourselves out as being a target. But I think I don't think that it is inevitable that there will be always be a lot of criticism on what we do. I do think it's early days, right? I mean, the concept, I mean, addressing climate action has really only kind of become a reality for a lot of people in the last 10 years. And the sector is still fairly young. We're going through some evolutions. And I think these are just growing pains for what I hope is going to be a very robust response to how we fight climate change. And I think that as things like the VCMI start to define what kind of claims you can have, and work of the ICBC, the Integrity Council for Voluntary Carbon Markets, sets out what counts as a real credit. I think that will start to kind of tamp down a lot of the inevitable criticisms that people have about the market, and start to hopefully, put it on an even sounder footing so that we can actually have real climate change. So I think it's just part of kind of the reality of what we have to face today. But I am confident that going forward, things will be more solid, and that the market will have clearer guardrails and goalposts on where to go.
Thanks, David. B, a question I want to put to you. As I recall, it was you that brought up the concept of contribution claims rather than carbon neutrality claims. Do you have any examples of companies working with those?
I'm afraid I don't, but can I cheekily really quickly just add to something that David said, and then perhaps Sam may have some examples on that. But just to note on that, how controversial it's going to be, I think it remains to be seen from my perspective in terms of what policymakers do, but also there is a sort of wider context, right, where certain companies are perhaps not taking the climate action that's needed and are large purchasers of carbon credits. And I think while that continues, there's going to be a conflation of voluntary carbon markets with that kind of climate laggardism, and that's maybe part of the root of the issue as well. But yeah, sorry, I'm bouncing you back the question to you on contribution.
That's all right. Sam, do you have any examples of this, contribution claims versus carbon neutrality claims?
Yeah, I mean, for example, if you look at what Stripe is doing, it has a large carbon removals program, and to my knowledge, they haven't made any environmental claims off the basis of that program, which I think is very responsible, because if you look at a lot of these new removals methodologies and technologies, there are real problems again around how the carbon accounting is undertaken for those types of approaches. So I think they've been conservative there in saying, look, we want to help this market scale. We think it's really important that we support it, but there's not a sufficient level of confidence. And also ideologically, we're not trying to make an environmental claim, we're just trying to be part of the solution. So I think that's a good example of a company that is supporting climate action without making that claim. I'm just trying to think of some others. I'll come back to you on that. Quite a few people are talking about this in behind closed doors at the moment. So I think it would be I think it's quite likely that you'll see a shift happening this year around the types of claims that are being made after purchasing carbon credits. Yeah.
Thank you. Thanks, Sam. As I've mentioned at the top of the hour, I am prepared to let people come in and make a question live. So if anyone does want to make a question live, then do stick your hand up and we will bring you in. Another question I want to put to, and I think perhaps I'll see the panel briefly respond to this, is looking at the quality of projects. Some we've talked about already, clearly very important. And the question simply is, what are you guys doing when working with the wider sector to support and empower to improve the quality of carbon projects? David, do you want to go that quickly? Briefly,
I guess, please. Yeah.
There you go.
So, we're doing, to begin with, we review every project that comes in the door. And I see some questions about what's the role of third-party auditors or validation verification bodies. And, our job is to make sure that they're doing their job. And with the crush of projects that we've seen, I mean, I'm sure that there's some developers on the line who are not pretty happy with us because we're taking a long time to process their projects. And that's because we have to do our due diligence. So there's a fundamental role that we play to make sure that the projects and the credits that we issue have integrity. And that's really, really important. And we're kind of going through this process. We're actually getting through a lot of this backlog that we've had, and we're working through it, and it's going to see some really good results of that. But it's taken a lot of organizational effort to make sure that we can actually review all these projects, but maintain the quality. But then there's also ongoing things that we do to make sure that our rules continually improve and reflect best practice, latest scientific evidence. The example with RED is a good example. The example with our consultation on the VCS program is another one. If we just developed our rules and put them on shelf and expected them to last forever, that would not be a responsible approach because things change. I mean, RED, great example, right? We knew at the time that the best way of identifying a baseline for a project was to find a legitimate reference area that was as similar as you could to the actual project area, and that had suffered the same sort of deforestation threats. But now we're moving to a different model, and that may play out for other sectors as well. So we're constantly looking to improve the rules, and I think that's kind of if that's one of the key things that we do, in addition to making sure that everything that does get come to our desk actually follows all the rules.
Thank you very much indeed. Either Sam or B, do you want to comment on that quickly?
The only thing I'd say is I think technology is increasingly helping here. So the amount of data we're now able to capture using satellite data and other techniques is really helping to bring a lot more transparency into the market. So for example, the types of techniques that actually were used in the Guardian article, if calibrated in a more holistic way, can actually be very useful in understanding the real risks that projects are exposed to. And actually those techniques are used in the JNR methodology, for example. Also, for example, we're working with a number of academic groups and using LiDAR data to actually scan the planet's forests and then using that to calibrate our machine learning models. And so what we're actually seeing is in many situations, the amount of carbon stored in the forests is actually underestimated. So we've talked a lot about how uncertainty can bring questions into the carbon market. Sometimes that uncertainty is actually meaning we're underestimating the impact of these projects. So it's not always negative uncertainty. But I think that the advent of technology and the proliferation, particularly of increasingly higher resolution satellite data, is really helping the market as well.
Thank you. We do have an attendee who wants to make a question live. So it's Mr. Gupta. So perhaps if my colleagues can enable Mr. Gupta to join us audio. Mr. Gupta, can you perhaps just tell us who you're with and make your point. Please make your point quickly. We're running short of time. So a very quick question, but please, Mr. Gupta.
Yes, I'm from India. And I am currently on a committee which is making recommendations for the National Carbon Exchange, which has been in process for development in India. My question to all the panelists and perhaps more to David is that many countries have their own national carbon exchanges now. China has gone that route, and we've seen Korea go that route. There is in Europe, there's EU, and then there is the Swiss exchange, and they have interoperability. How do you see the future for the voluntary carbon market if there are so many exchanges opened up nationally, and a number of them are trading even within their own nations? I mean, they're not even trading within exchanges or trying to develop equivalence with other exchanges. So if there are so many standards and methodologies, what do you see for the future for voluntary carbon markets?
Thank you. Great question, David.
That's a great question. So I think that going back to the work of the ICBC and the Integrity Council for Voluntary Carbon Markets, ultimately, all of these exchanges you mentioned have to rely on a set of credits, right? And in order for them to work, or they probably will need to identify which credits they accept into their system. We can link to any of them through an API. That's a simple technology fix. But the authority, whether it's the country or the exchange, needs to decide which credits they're going to accept. And then that allows them to have access to credits from different programs like the VCS. So I think that it's a matter of figuring out a set of consistent rules that allow these exchanges to determine which credits they accept. So there's already two examples, kind of national examples, where this is played out in Colombia and South Africa. They have carbon taxes, but they allow credits from either the VCS program, the gold standard, and the CDM to be used to meet that compliance obligation. So they've kind of gone through a set of rulemakings, if you will, that's set in stone what credits those are allowed. So in the exchanges need to do the same. My guess or my hope is that once the ICBCM, has a set of kind of requirements and has approval for credits, then that would be an easy thing to base it on, so that exchanges would say, oh, we'll just accept ICVCM eligible credits, for example. So that would simplify that process and reduce some of the confusion that's out there.
Thank you very much indeed. Sam, B, did you want to jump in on any of that briefly? Okay, that's fine. Price, I want to turn to price. So the question makes a point that was B, you raised initially. So our question points out with carbon credits at $3 a ton, it's always going to be cheaper to offset than to reduce. How do we get this right? How do we solve the problem? What is necessary to? Here's a reform, our title of our webinar. How do we reform this so that the price is realistic?
Yeah, that's a really good question. So I think there's a couple of parts to it. So one is, I think the low price at the moment in general sort of raises questions around if a project really is delivering what it claims to be delivering and verifying fully, given most estimates I've seen suggest it would cost a lot more than that to actually deliver those outcomes and projects. So with increasing quality, we'd hope to see a rise in price. Although obviously it's great if you can deliver a project at low price to quality. But I think it really loops back to that piece around what a credit is used for. So we probably can't get the incentives right just through price alone, or at least immediately. So it comes back to that point around companies not being enabled to use credits to make things like net zero claims, and making sure the incentives are in place at the buyer end that they're directly decarbonising their operations in the first place. So, for example, one thing that we recommended to the UK government was to set out a legal definition of net zero for businesses, so that therefore credits would only be used as a sort of last resort, and before that they're being used in addition to directly decarbonising. So that's one way, but yeah.
Thank you, B. David, you want to come back in?
Yeah, no, I think B made a really good point. Again, it goes back to that definition of what net zero or carbon neutrality or whatever term we choose to use, but that has to be defined and agreed to. But I think let's remember that, you know, carbon credits will most always be less expensive than internal reductions. Again, back to the emissions trading system that Europe, implemented. There were carbon credits that were meant as a way to allow companies to meet their targets at a lower cost. And that's likely to play out, but just because the credits are lower cost than the actual reduction doesn't necessarily mean that they're bad. I think, again, they play a complementary role, and if there's a clear definition of what you can claim when you are buying credits, and ideally it does include, essentially making companies take on internal reductions, then I think you hit that sweet spot where you get the holy grail of real climate action, where you're decarbonizing an economy, but also you're investing in places where you can actually prevent emissions from going to the atmosphere, or investing in removals, which are critical for the long term.
Thank you very much, David. We're coming towards the end of our time. Time has just flashed by. I'd like to ask each of our panel a single closing question, really. What do they think is going to happen over the next 12 months? What are they looking out for in terms of the carbon markets and the reforms that we've been talking about? Well, what are they looking out? What are they looking forward to seeing? Sam, why don't you go first?
I'm personally really excited to see the outcomes of like the ICVCM, the VCMI, and the SBTI work. I really personally hope that they're well calibrated and that they're actually complementary. I think that's probably the biggest risk for the market at the moment, is that these different initiatives come out with contradictory or conflicting perspectives. I think that would be really problematic for the market. So I'm excited to see if they can agree, and if they can put out some helpful guidance. And the second thing is I'm really excited to see how the advances in technology and data sets like Silvera's are able to help the market collectively raise and sort of voluntarily raise the bar in terms of quality. Yeah. Thank
you, Sam. B, very briefly, if you would.
Yeah, totally agree with Sam on SBTI, VCMI, ICVCM. I guess maybe from a UK perspective as well, excited to see the progress from the Transition Plan Task Force, who looks set to require companies to disclose their reliance on carbon credits or offsets. And the UK government's due to publish an updated green finance strategy in the coming months, and we're hoping to see some commitments there from offsets, but let's watch that space.
Thanks, B. And David, what are you looking for the next 12 months?
So I agree. I look forward to the ICVCM and the VCMI SBTI outcomes. Let me say, though, that I think they're really important, and again, I hope that they'll provide a thoughtful way forward. But I also think that there's no reason why we should halt climate action now. Anybody who's looking at this market, should understand that you got to be careful about the claims you're making, and you got to do your due diligence on which projects are out there. But I think that a lot of the concern around the market isn't necessarily around integrity; it's around confusion, and you can solve that by being thoughtful about it. And then just in terms of the specifics, I'm really looking forward to our consultation on the VCS program. And to bring it back to the original point, I'm really looking forward to being able to publish our new methodology for RED, which I think is going to set the stage for how this grows and how this drives further climate action going forward. Thanks again for the invitation.
Sure, no, thank you. We're out of time. Many thanks to our panel for all their insights and candor over the past hour, and for all your questions. We've had a significant number of questions for sure. We'll be in touch with a link to the webinar recording in the next few days. We'll be conscious, as I said, to ensure that we do edit it so that any instances where perhaps any of the panelists spoke a little quickly and I'm the worst offender, we will make sure that is addressed, because I do take the point that we need to ensure that this is accessible, or as accessible as possible. And look out for the next in our big debate webinar series, which is coming up in a few weeks, where we'll be looking at the rise and fall and possible rise of the meat substitute sector. We also have our climate action event, Innovation Forum, coming up on the 12th to 14th of June, where a lot of the stuff we talked about today will be very relevant. We'll do our very best to capture all the reports on the chat, all the data and everything that's been shared. It's been a great webinar. Thank you very much for joining us. And for now, goodbye.